This has been a roller coaster few days for the U.S. economy. What does this rebound for regional banks mean?
Well, Jake, this is one sign that confidence may be starting to return, that perhaps cooler heads are prevailing. This collapse of Silicon Valley Bank, this was driven by psychology and emotion, panic specifically. And then we saw regional bank stocks collapse yesterday despite the fact that the federal government launched this massive rescue of uninsured depositors over the weekend. So it is certainly encouraging to see a reversal today. As you can see on your screen, regional banks closing sharply higher, although I would note that some of these gains kind of lost steam as the day went on. More important than the stock prices is what's actually happening with deposits. Now, unfortunately, we don't have that much transparency into deposit flows, but a senior Treasury official told CNN's Phil Mattingly that deposit outflows from small and mid-sized banks, those have eased. And that, of course, is exactly what U.S. officials want to see. They want to stop the panic before it spreads elsewhere, and they want to restore confidence. Of course, Jake, that's not going to happen overnight. Confidence is a fragile thing, and it was clearly shaken by the last few days.
So, Matt, we know that the Justice Department is investigating the collapse of SVB, Silicon Valley Bank, and reportedly, according to the Wall Street Journal, the SEC is also investigating. What might these investigations look like? What might the outcomes be?
Well, Jake, I think there's two big questions here. I mean, was this just bad management, or was there actual wrongdoing done here? Now, the Wall Street Journal is reporting that there's two points of focus here from these investigations. One, the actual collapse of Silicon Valley Bank. Two, stock sales done by executives at this bank in the days before the collapse. Now, we should caution that these investigations are in the preliminary stage, and we don't know yet whether any civil or criminal charges, whether any findings of wrongdoing will come out of this. But Jay, clearly the government is very interested in finding out what happened and making sure it doesn't happen again.
All right, Matt Egan, thank you so much. There is a new warning sign in all of today's economic data. Credit ratings firm Moody's has officially downgraded its outlook for the banking industry, and it is keeping an eye on 6 specific banks. I want to bring in Justin Wolfers. He's a professor of economics and public policy at the University of Michigan. Justin, thanks for joining us. Moody's downgrading the outlook for the banking industry. What does that mean in practice? What does this mean for people watching right now?
I think one answer is not very much. So when we see bank stock prices fall or their credit ratings start to get cut, it could be that there's a liquidity problem there. That's the sort of bank run problem. But I think what's really happening is at the end of all this, there's going to have to be another close regulatory look at what these small and medium-sized banks are doing. Silicon Valley Bank took some big bets. It put people's money at risk. It wasn't okay. That's going to have big implications for how we regulate the industry and for the future profitability of some of those banks.
Do you think other banks are still at risk of failing?
No. First of all, Silicon Valley Bank was special. Most of your viewers, those who have less than $250,000 in the bank, don't need to worry about any of this at all because your funds are insured by the government. They say, if there's no money in the vault, we'll send you the money anyway. The problem with Silicon Valley Bank, its customers, mostly venture capitalists and startups, had gobs of money in the bank, way more than $250,000. The money was effectively uninsured. That's what meant that customers were willing to run away at the first sign of trouble. Other banks aren't in the same situation, and that's why we're not seeing broader contagion.
The chair of the House Financial Services Committee, Congressman Patrick McHenry, said the collapse of Silicon Valley was driven by, quote, the first Twitter-fueled bank run. Explain what that means.
Well, let's just go back and think about what a bank run is. A bank run is when all your customers if too many customers turn up and want to take more money out of the vault than you've got in the vault. If you're a bank with only one customer, then if that customer turns up, you're necessarily going to get a bank run. Fortunately, most banks have millions of customers. That's not a problem. Silicon Valley Bank, though, first of all, it had a large number of customers, but they were all in the same industry. They were startups. They were all answering to the same VC firms. So it was like only having a small number of customers. They're all very closely tied, and they're all tweeting at each other, get your money out. They're texting each other, get your money out. And so normally a bank run happens over a period of hours as you literally have to get to a branch, try and get cash out and discover there's nothing left in the vault. In today's supercharged digital world, it can happen a lot faster.
New data shows that inflation fell for an eighth straight month. It's still at 6%. The Federal Reserve wants that number to be 2%. How much longer do you think we'll be paying higher prices because of higher interest rates in order for the Fed to achieve their goal of much lower inflation?
There was both good and bad news in the inflation report. Inflation's come down from the really dramatic levels of 7, 8, 9%. It's currently 6%, and if you look over the past few months, it may be even closer to 4 point something or 5 point something. But that's still a long way above where the Fed wants it to be, and it's not clear that inflation's trending down anymore. So the Fed is going to continue to raise interest rates until it starts to see inflation come down. And it's probably going to continue on that path, maybe a little slower because of Silicon Valley Bank, but pretty much on the same sort of interest rate raising path that we saw before.
All right, Justin Wolfers, thank you so much. Really appreciate it. Joining us now to discuss, former Republican Senator Pat Toomey from the great Commonwealth of Pennsylvania. Toomey was the top Republican on the Senate Banking Committee until he retired from the Senate a few months ago. Senator, thanks for joining us. In 2018, you were one of the leaders behind the 2018 bill to roll back parts of the Dodd-Frank Financial Reform Act, which eased restrictions on some banks. We've heard President Biden and others saying that this rollback could have contributed to the banking failure. Take a listen to Bernie Sanders, Senator Sanders, on the floor of the Senate in 2018, warning that a bank pretty much this size, Silicon Valley Bank, would be likelier with this deregulation. Let's roll that clip.
Just yesterday, the Congressional Budget Office told us that the legislation we are debating today will, and I quote, increase the likelihood that a large financial firm with assets of between $100 billion and $250 billion would fail, end of quote. That's the CBO. In other words, this legislation makes it more likely that we will see another financial crisis.
So here's the CBO report Senator Sanders is quoting. The part about this is not a huge part of it, but the basic argument is that the stress tests that had been required, that are no longer required, could have caught Silicon Valley Bank's interest rate risks, the problems that they were having investing in treasury bonds too much. Is that not possible?
Extremely unlikely, and here's why, Jake. There's actually two arguments that people who objected to this very modest rollback of regulation cite. With respect to the stress test, what they don't point out is while we relieve the obligation to do one category of stress tests to a biannual rather than an annual frequency, they're still obligated to do ongoing stress tests for other purposes. And here's the more important thing fundamentally. I don't think anyone designs a stress test to test the result of losing 40% of your deposits in 24 hours. That's what happened. So I think that's completely specious. They also will sometimes cite the relief from the liquidity coverage ratio. The fact is, despite the fact that SVB was no longer mandated to meet that, it almost certainly exceeded that requirement also. So this had nothing to do with 2155, nothing at all.
Well, I take your point on the run on the bank, but wouldn't the stress test wouldn't have discerned, somebody wouldn't have been able to say, hey, I mean, it doesn't sound like the bank was managed very well. Hey, you have too much invested in treasury bonds, and when inflation goes up, and interest rates go up, like that's going to be a real problem.
I mean, the duration mismatch they had would have been obvious at many levels without requiring the stress test. The point is, the stress test is usually designed to measure what happens under various stresses. And I'm saying that there's no stress test that's designed to measure the results of something anywhere near as severe and radical and immediate as what SVB underwent. What I think, Jake, I'm sorry, that we've got to focus on here is it's very hard to overstate the role of the Federal Reserve in this. Just think about it this way. Wildly unprecedented easy money sloshing around on a massive scale, combined with all the spending that was going on, absolutely was a big source of the surge in deposits. That's the first point. Maintaining zero interest rates, and in fact, negative real interest rates, pressured all the banks to move out the risk curve. Now, in the case of SVB, it wasn't a credit risk curve, but it was a maturity risk curve. And then finally, when the Fed eventually realized how badly they'd gotten this wrong and they very quickly raised rates, they drove underwater the very bond portfolios that they themselves had created at the bank. So, coming and going, this has the Fed's fingerprints all over it.
Do you think that the people who might have encouraged the run on the bank, venture capitalists, individuals on Twitter or other forms of social media, bear any responsibility for this?
It's hard to fault people from observing what they think is a problem and notifying people of that, right? They may be right, they may be wrong. I don't know what their motives were, but free speech is a pretty important bedrock of our country.